Good afternoon, everybody, and thank you for joining us for What's the Long-Term Outlook. My name is Ben Tomczyk on behalf of everyone at the Committee for a Responsible Federal Budget. We're happy to have you this afternoon. Before we get started, just a few housekeeping items. As always, we are recording this video and live streaming it over Facebook. We'll also be sending out a copy of the presentation after today's webinar. Additionally, as always, we love to make these webinars as conversational as possible. We encourage you to use the question and answer feature at the bottom of your screen to submit any questions you may have throughout the presentation. Earlier this week, the Congressional Budget Office released their long-term budget outlook. Spoiler alert, it doesn't look good. To help us understand that more and to do a deeper dive into it, I'd like to introduce my colleague, Marc Goldwein. Marc is the Senior Policy Director at the Committee for a Responsible Federal Budget. And Marc, I'll let you take it away. Tell us, what does this report mean and where do we go from here?
Well, thank you everyone for being here today. As many of you know, the Congressional Budget Office frequently releases what it calls its baseline. Its projections of revenue and spending for the next 10 years, and then its long-term outlook, which projects out 30 years or more. Our last baseline was in March, and even though it was published after the coronavirus crisis had already begun, it was published with data from pre-crisis. And so what it told us is what the outlook looked like when things were sort of good, when all we were dealing with was a fiscal crisis on the horizon. And not an economic crisis right in front of us. Since then, many of you have heard me and others update you on what it looked like the deficit was going to be this year, what the outlook was, what we're doing in terms of COVID aid. But earlier this month, CBO finally, I shouldn't say finally, but CBO released its first post-COVID 10-year baseline. And then last week, it released its long-term outlook, which builds off of that baseline. And what I want to do today is talk about some of CBO's findings and then take all your questions. Ben, if you could just give me a thumbs up that everybody sees my presentation, I'd appreciate that.
Yes, we're good.
Great. So let's get started. This happens almost every single time I give a presentation. The first time I try to advance the slide, it freezes. So bear with me for a second. It never happens the second time. So once we get it moving, we'll be good. Here we go. So this was the fiscal situation prior to the coronavirus crisis. Again, as I mentioned, CBO's March baseline, even though they knew the crisis was already here, was based on older economic data. Even under that sort of strong economy data, where the unemployment rate was 3.5%, CBO was predicting the deficit would be over $1 trillion this year. Last year, in 2019, it was $984 billion. That's really the highest the deficit has ever been when the economy's been this strong, certainly during peacetime. It's not the highest it's ever been. Back during the Great Recession, it was 1.4 trillion, but that was pretty temporary. And as you can see in this graph, deficits had come down to almost 400 billion before beginning their gradual rise. So we were facing, prior to this crisis, $1 trillion deficit for 2020, and the continuation of $1 trillion plus deficits for the next decade. Then, of course, the crisis hit and turned what was already a very, very large deficit into a massive, unheard of deficit. The fiscal year is about a week from being over, and I wouldn't put these numbers in the bank because they are still just projections, but CBO projects that over the course of fiscal year 2020, which started October 1 of 2019, so about half of it really covers the COVID crisis, the budget deficit was $3.3 trillion with a T, trillion. That's 2.5 times that previous record of 1.4. It's over 3 times what it was last year and what it was projected to be, $3.3 trillion. And while deficits are expected to come down, at least if there's no COVID relief or other legislation, they're projected to remain quite high. They're never going to go below $1 trillion under CBO's baseline. And by the end of the decade, they're projected to rise back up to roughly $1.5 trillion under current law. Again, that's a current law projection. Current law assumes that we start increasing appropriations only with inflation, which recently we've been doing a lot more. It assumes that most of the Tax Cuts and Jobs Act expires at the end of 2025. It assumes that there's no more COVID aid. It assumes tax extenders end, which they should. But if you remove all these assumptions, instead assume Congress kind of keeps doing what it's been doing, along with another trillion of COVID aid, which I think is sort of a low end number of where the negotiators are. We project deficits are never going to fall below their old projections. And by the end of the decade, we'll be talking about over $2 trillion per year of borrowing. Our 2030 deficit projection is $2.3 trillion, right? 3.3 trillion this year is pretty enormous, but that's a one-time event because of the coronavirus. What we're talking about in 2030 is a $2.3 trillion deficit, despite the economy being totally back to normal. And not surprisingly, this is going to have massive implications on the debt. Again, if we go back to the pre-COVID baseline, debt has already grown over the last decade from about 60% of GDP, 40% if you go back to sort of the end of the Bush era, up to 80% at last year. Now, this year alone, we'll talk about it in a minute, it's going to rise a lot, but pre-COVID projections, it was projected to grow another 20% over the next decade, from about 80% at the end of 2019 to almost as large as the economy by 2030. Now, instead of a debt at 98% of the economy in 2030, CBO projects the debt will be 98% of the economy this year. In other words, our current debt is about as large as the economy. We basically advanced forward our bad debt situation by a decade. And it's going to keep rising. We expect it's going to exceed its previous record of 106% by 2022 or 2023. And then it's going to grow pretty slowly. It's not actually that debt is growing slowly, it's more that CBO projects sort of a pretty robust economic recovery. So debt to GDP is going to grow slowly because debt is growing rapidly, but GDP is also growing rapidly towards this recovery period. But ultimately reach 109% of GDP by the end of the decade. This is higher than any time in history, including right after World War II when we hit our previous record of 106. And again, this is current law. Under our alternative scenario, we project that is going to reach 121% of GDP. Now, what's driving this massive increase in debt is mainly the COVID response. I think most of you have probably been on one of my webinars, and so you're aware of our COVID money tracker. If you're not, visit covidmoneytracker.org. We are tracking every single dollar spent through the Federal Reserve, the legislature, legislation or executive action. We're tracking loans, we're tracking tax deferrals, we're tracking grants, we're tracking spending. You can look at them by state, by recipient type, by industry. And just on the legislative side, $2.3 trillion has already gone out the door. We expect ultimately $4 trillion is going to go out the door. Or I should say, we expect $4 trillion has been allowed to go out the door. Some of that will never be spent. Some of that will be paid back. But on net, we think the deficit impact is going to be something like $2.5 trillion plus. And this really is what's driving that increase in the debt. This table here is very busy, and I don't expect everyone to study in all detail, but this shows CBO's old deficit projections, $1 trillion in 2020, 14 trillion over 10 years, and its new projections, 2.2 trillion in 2020, 3.3 trillion in 2020, 16.3 trillion over 10 years. And it shows the difference. Basically, all the difference this year and all the difference over a decade can be explained by COVID relief legislation. I apologize, this is a wrong chart that got put in here, so I'll have to send you the right one. My policy analyst, John, is going to kill me because he sent me the new corrected version of this, but I accidentally just opened the wrong PowerPoint. So this is all on me, but the overlying numbers are correct. The details here are not very meaningful, but I'll walk you through those during the Q&A. This year alone, we expect spending as a share of GDP is going to spike to almost a third of GDP, 32%, while revenue is going to fall by next year, 15.5%. This is temporary. Spending is going to go back down, but it's not going to go back down to where it was before, because even once we get past this COVID crisis, which is in the near term dramatically increasing deficit and debt, large structural imbalances remain. By 2030, under current law, we expect over a 5% of GDP deficit. We expect spending to be higher, much significantly higher than its historic average, even as revenue is just right at about the historic average. If you look going forward, CBO now has its 30-year long-term outlook. What you can see is that are structural, and you can see here, because I'm using the wrong number, Grwo is spelled wrong. But what you can see is that our structural imbalances are growing mainly due to the growth of three programs, three parts of the budget: Social Security, healthcare, and interest on the debt. Back in 2005, Social Security cost about 4% of GDP, meaning that 4% of total economic output was put to Social Security. Now it's about 5%, and by 2050, it's headed to be 6.5% almost. Healthcare was less than 4% back in 2005. This is all healthcare, Medicare, Medicaid, et cetera. It was over 5% last year, about 6% now, headed to 9%. Now, some of this expansion is new spending, things like Medicare Part D that was established in 2003 and started really not spending out until 2006, 2007. Obamacare, which increased spend in Medicaid and subsidies. But most of this is spending on the same exact programs, just growing quickly. Why? Because the aging of the population means more people are collecting Medicare, and to a lesser extent Medicaid, and because healthcare costs continue to grow faster than the economy. And for those two reasons, health costs are continuing to grow rapidly, as are Social Security costs. Meanwhile, because we're not raising enough revenue to cover our spending, our deficit and debt is growing. And the more deficit and debt we have, the more interest payments we make. Thanks to the current crisis, interest payments are down now. Interest rates are so low that even with more debt, interest payments are down. But that's not going to last forever, both because we do expect interest rates to recover, at least to some degree, and because as your debt rises, even at very low interest rates, your interest payments will be very high. We expect interest to grow from about 2% GDP last year and 1.5% this year, up to 8% of GDP in 2050. That will make interest the single largest federal government program. And the combined growth of Social Security, healthcare, and interest will explain more than the entire spending growth. Meanwhile, revenue will grow, but only a bit, from about 16% up to 18.5% by 2050. Not enough to nearly cover this new spending. And again, this is the optimistic current law scenario. Under our alternative scenario, the situation is far, far worse. Instead of facing deficits of 13% of GDP, which is, by the way, higher than any time during the Great Recession, higher than any year in history other than World War II or this year, we expect deficits of 16.5% of GDP, which would eclipse even this year's deficits. We're frozen again, so here we go. So this high and rising deficits, as you can see here, is really substantially worsened from where we were. Before we were headed to 9% of GDP deficit, which was really bad. Now we're headed to 12.5% and maybe 16.5%. The long-term debt outlook is bad. It is far worse than it was before. And this is all when the coronavirus crisis is well behind us. And it's going to play into, as my slides are going slow, I apologize. But it's going to play into a rising national debt. So as I mentioned, our previous record for debt was 106% of GDP. We are likely to exceed that by 2023, 2024 or so. By 2050, CBO projects debt will be twice as large as the economy, 195% of GDP. There's no historic precedent for that. There's really only one international case of debt at that level, and that's Japan, who's experienced about 30 years of no economic growth. Outside of Japan, countries that start to get even close to this high tend to either make a major correction or have some kind of crisis. And by the way, again, this is the optimistic scenario. Under our alternative scenario, debt could be 250% of GDP, perhaps even more. We are on an unsustainable fiscal path, folks. And this is, again, way worse than previous projections, to some degree because of the coronavirus crisis, but also because even just over the last year, we've continued to be fiscally irresponsible. We passed a major budget deal that sort of made permanent big increases to defense and non-defense spending. CBO assumes that will then sort of flow through past when the caps expire. We repealed a bunch of taxes related to Obamacare, which only cost us $500 billion over a decade, which is a lot, but small relative to, say, the COVID relief. But we're the kind of taxes that we're going to have increasing effects over time, and we're meant to temper healthcare cost growth. And because we repealed taxes that would have tempered healthcare cost growth, that's going to cost us another 10% of GDP. And then on top of that, the economic situation overall is likely to be worse, in part because of our higher debt. We think that debt is going to slow economic growth, in part because during this COVID crisis, we're experiencing lower immigration, and in part because we experienced a little lower inflation that's going to flow through. But overall, instead of projecting debt at 144% of GDP in 24, now we're at 189, significantly worse than previously projected. As I mentioned, this high debt is likely to slow economic growth. In the very near term, interest rates are near zero, and the Fed is purchasing a lot of our debt. And what the Fed isn't purchasing is being bought essentially in short-term money market accounts for very short-term savings. And so we're not seeing a lot of what you consider crowd out, where people are buying debt instead of making other investments. But that's going to change increasingly over time as things start to normalize. And CBO thinks that over the next 30 years, there's going to be actually substantial crowd out. And GDP, the economy, is going to grow 0.2% slower per year as a result of higher debt. 0.2% per year is a lot. The entire benefit of the tax cuts was about 0.5% over 10 years. At sort of peak, it was so we're talking about 0.05%. The economy would otherwise have grown, the economy had been growing about 2% a year. The tax cuts alone mean it's going to grow, the debt alone means it's going to grow closer to 1.8. And other factors mean CBO think it's going to grow closer to 1.5% per year. That is dismal economic growth. 1.5% growth is about half of the growth that we've experienced historically. And that itself is going to worsen debt as well as, and more importantly, overall welfare. Thought of another way, because debt is rising between 2019 and 2050 as a share of the economy, CBO thinks that per person income will be $6,300 lower per year. In other words, the average person will be $6,000 per year poorer. If you're a family of five, you can do the math on that. That's $30,000. It's not that it's distributed evenly that way, but this is a per person number of reduced income in a single year. And that's just the difference between having a record high debt and CBO's projection for a new record high debt. If we could actually reduce our debt back to where it was before, we'd instead see more quickly rising income. Meanwhile, interest, as I mentioned, is by far going to be the fastest growing part of the budget. Not over the next decade. Over the next decade, CBO expects interest rates will be so low that it's not going to rise very quickly. But once interest rates recover, with debt growing so fast, the interest on that debt is really going to eclipse everything else. And since we know this 2050 level of deficit is not sustainable, that means that every dollar we're spending interest is a dollar we cannot spend on something else. This is dollars that we're spending on past instead of being able to spend on the present or on the future. Just because I don't want to cheer you guys up too much that we face a dismal economy and declining fiscal space, we also face a bunch of trust funds that are in trouble. Every single major trust fund is projected to run out, according to CBO, within the next 11 years. The Highway Trust Fund in 2021, although the new continuing resolution might push that to 2022. The Medicare Part A Hospital Insurance Trust Fund in 2024, the Disability Trust Fund in 2026, and Social Security's Old Age Trust Fund in 2031. Think about this. That means somebody 62 today, new retiree, will be 73 when Social Security runs out. This isn't something you got to save for your kids or your grandkids, something you got to save for your grandparents, and we are running out of time. And by the way, the longer we take to fix the debt, the harder it will be. I don't know very many people that think that the right time for deficit reduction is now, although of course, if there's no-brainer policies, we can pursue them. I don't think that anyone thinks that during the worst economic crisis since the Great Depression, we want to move to quick austerity, but we need to keep our eye on the ball of this long-term debt. And while the focus should be the COVID crisis, we cannot continue to expand the debt over long term, and we need to come up with a plan to reduce it. If we start that plan in 2025, if we start in 5 years, just to get the debt back to where it was at the end of last year, we need the equivalent of about 3.5% of GDP of savings per year. That basically means increasing all taxes by 20%, or it means cutting spending by about 15%. If we were to wait till 2035, instead of 3.5% of GDP, we need almost 6% of GDP. The tax increases we would need or spending cuts we would need would be much larger, and they'd have to be much more abrupt with less warning and less ability to phase in or target. This is already a very challenging problem, but the longer we wait, the more challenging it gets. And at that point, I'd be happy to take anyone's questions. Hopefully you're all very depressed and inspired to work to fix this situation.
Mark, I think when I began the webinar and said that, spoiler alert, the outlook was an understatement, we have a couple questions. Group the first two together. You'll see why. Sigmund writes in, according to MMT, this is not a problem. So why do you think this is a problem? And we also have a viewer who writes in saying, you know, as long as the US is the global standard regarding currency, do deficits really matter at all?
So let me start with the second question. Do deficits still matter if we're the global reserve currency and the gold standard? Here's what I would say. So long as the United States borrows in its own currency, is the strongest economy in the world, has a relatively stable political system, and is the world's reserve currency, we have higher debt capacity before we would hit some kind of crisis than we otherwise would. But deficits still matter. They matter, and in that situation, we would never default on our debt. They matter in a few ways. First of all, even if we can borrow, and even if people keep wanting to lend us, it doesn't mean that borrowing is costless. Every dollar that somebody spends on a US Treasury bond is a dollar they could instead be spending on investments in the private sector. And if the United States is borrowing mainly to fuel consumption, to fuel tax cuts, to fuel spending on Medicare, et cetera, then it's essentially diverting money towards consumption away from private investment. And that private investment is what helps to grow the economy. That's why CBO thinks that the economy is going to grow 0.2% slower per year, because there's going to be less private investment. We can be the most credible debt in the world and still have that. On top of that, to the extent that foreigners are buying our debt, yes, we will have more investment, but those foreigners that buy the debt get more of the returns to that investment. We also have these other issues. Rising interest payments mean that we'll have less flexibility in the future for tax cuts or for new spending, and we'll have more of a need to cut spending or increase taxes in the future relative to today. And lastly, I'll say there's no guarantee that we're always going to maintain our credibility in the world. Credibility is one of those things that you have until you don't. And if we even lose a little bit of it, it could have a cascading effect. If the global financial markets even think there's a small risk that we won't make good on our debt, either because we'll inflate it away, or because we'll default, or because we'll find other ways to restructure it that won't be advantageous, they'll start to demand a higher interest rate. And if they demand a higher interest rate on new debt, it suddenly makes trillions and trillions and tens of trillions of outstanding debt less valuable. And if that caused a mass sell-off of existing US debt, you could see a financial crisis. And so this may be a situation of the bigger they are, the harder they fall. We have the credibility for now, it might not last. Now, as to the question of MMT, I'd say the scenario I painted would matter even under MMT. MMT is basically an idea that you can money finance all your debt, and that we are effectively money financing it. And so you don't really have to worry about debt. You just have to worry about too much money. But if we're having deficits of 8 or 16% of GDP per year, under that situation, I think we're at very real risk of high inflation. And that's assuming that you believe MMT's framework. I think that most credible economists on the left and the right don't realistically think that we can live in a world where all of our money is all of our deficits are essentially money financed. It turns out this is not a novel idea to print your way out of your debt. It's been tried lots of times before, by Zimbabwe, by Argentina, by the Weimar German Republic. It usually ends in hyperinflation. And I imagine if we went fully in the direction of MMT, we'd be there as well.
Mark, we're running low on time, so I'm going to try to do a lightning round here. We have a bunch of questions about the presidential candidates, which makes it timely given that Tuesday night is the first debate. Someone writes in and says, what presidential candidate is more likely to address the debt issue robustly? And then we have two questions about, how much of the situation we're in is due to the tax cuts that were supported by the administration, and what does a potential Biden tax plan mean for our fiscal outlook?
So these are all great questions. So we just did an analysis that shows that President Trump entered office with already precarious fiscal situation. Debt was the highest it had ever been. Deficits were projected to be rising as a result of the structural factors I mentioned, rising healthcare and retirement costs. We had projected in 2016 that if you had enacted Trump's entire agenda, it would have increased the debt by about $4.5 trillion over a decade. And we thought that was almost ridiculous. Nobody would increase the debt by $4.5 trillion in a period that deficits were already growing this fast. Now, as it turns out, kept those promises. We estimate that before the COVID crisis, the combination of the tax cuts that he passed with Republicans and the spending increases and other tax cuts, which he passed on a totally bipartisan basis, President Trump has signed into law or executive order almost $4 trillion of deficit increases, almost as much as he proposed during the campaign. This isn't all the tax cuts. About half of this is tax cuts, half of this is spending increases. And again, some of it is bipartisan tax cuts. So it's not tax cuts alone, but the point is that even before the COVID crisis, we've made the situation far worse. The 2019 deficit would probably have been about half as large as it was were it not for recent spending cuts and tax increases. I'm sorry, spending increases and tax cuts. Now, as for going forward, I'm not going to give that away because as part of our U.S. Budget Watch project, we are actually very close to releasing a comprehensive analysis that is going to compare both candidates' plans in their entirety. And you're just going to have to check back to see what we find.
Thanks, and we encourage everyone, if you aren't following us on social media, on Twitter at Budget Hawks or Facebook, please do so because we'll be tweeting that paper out and sharing it once it's published. Marc, let me ask two next questions. Number one, interest rates are really low right now. What effect is that having on our fiscal situation? And going back to campaign 2020, first debate is Tuesday night. Someone writes in, what should we be listening for?
So on the debate, I would love for the candidates to have a plan to reduce the debt. I would love for the candidates to have a plan to pay for their stuff. And I hope they ask about that. But I think maybe the most important thing that's facing them that's immediate is what are we going to do about these trust funds? Highway trust fund is a year from insolvency. Medicare trust fund is 4 years. Disability is 6 years. The old age fund is 11 years. The next president is going to have to deal with at least 3 of these trust funds, if not all 4 of them. And I would encourage Chris Wallace, if he's on our webinar right now, to ask them how are they going to address these trust funds, because they're all in very big trouble and they need very fast solutions that can't really wait, a decade or so. As for the interest rate question, low interest rates, largely as a result of the COVID crisis and the Federal Reserve's actions, have sort of been a gift on the fiscal front. They basically mean that the COVID crisis itself, on net, has reduced deficits over a decade. The response has increased deficits, but the COVID crisis itself, by reducing interest rates, has actually reduced deficits. But we don't expect those low interest rates to last forever. The Federal Reserve has said they will keep them low until the economy is rebounding or they're seeing inflation. But the Federal Reserve is has bought an awful lot of U.S. debt, and so sooner or later they're going to have to steer interest rates back, not necessarily to where they were in 2008, but certainly to above where they are today. They can't really stay at zero. And if they do stay at zero, I think there's some lessons we have from abroad of other kinds of damage that can cause to malinvestment, et cetera. So in the near term, low interest rates buy us some time, and we should use that time. We should focus now on addressing the coronavirus crisis, and we can phase in debt reduction gradually, taking advantage of those low interest rates. But over the long run, we're exactly where we were before, but with an extra debt load.
I just want to remind folks, we are going to be sending out a copy of this webinar, the presentation, and then We'll also send you a copy of the committee's analysis of CBO's long-term outlook, which was published earlier this week. We're rounding up on a half hour, so Marc, I want to say thank you for joining us this afternoon. If you are watching these webinars and enjoying them, we encourage you, please share them on Facebook with your friends and family, share them on Twitter. We'd love to have more people join us as always. And again, thank you for some terrific questions and for joining us this afternoon. Until next time, please stay safe, stay healthy, and we look forward to seeing you on a future webinar. Take care, everybody.